Good morning. I'm David Lillard, co-chair, along with Tim Ryan of the Standard Setting Process Oversight Committee of the Financial Accounting Foundation. I want to welcome you to this public session meeting of the Oversight Committee. And this morning we have a good agenda outlined, and we'll proceed with that now. The first thing I want to do is to remind everyone in the public session that this is a friendly reminder that the public session will be live streamed, and that is any public meeting. We will have listeners from the media most likely. Our goal will always be to have a transparent and productive discussion, and we simply ask that those in the room be mindful of these factors when asking questions or sharing commentary. We very much encourage trustees to engage in open dialogue and to address any matters on their minds. We thank everyone in the room and committee members and guests alike in advance for their participation here today. The first thing that we want to do this morning is call on Joel Black, the chairman of the GASB, the Governmental Accounting Standards Board, and Alan Skelton, the technical director, for the GASB report for the second quarter of 2023.
Thanks, Chair Lillard. Appreciate that. And it's great to see everybody. Good morning. I always appreciate the Oversight Committee's oversight, but giving us an opportunity to talk about the GASB activities. And as David said, we'll cover the second quarter. In your materials, page 9 has the focus areas. We're basically going to walk through the projects on our agenda and give you an update on what we have going on with those, including the post-implementation reviews. Highlights for the quarter are on page 10 of your materials. We will cover all those high-level agenda things as we get to them. The monitoring activities, we do continue to devote staff resources to electronic financial reporting, in particular, working towards still beginning stages of developing a financial statement taxonomy that can be useful in financial reporting, including possibly the Financial Data Transparency Act. So I won't really talk about that anymore in this session, but it is something we continue to work on, but no major new developments there. So if you continue then on to slide or page 12, you can see an overview roll forward of our tech agenda, and the 2 additions and 2 removals there are related to each other. One being that we concluded pre-agenda research on the capital assets, and the board did vote to add a project on infrastructure assets specifically related to that research, and Alan will talk more about that project when we get to it in the deck. And then the practice issues, the removal reflects the issuance of the 2023 update to our implementation guide. And then the addition is a 2024 implementation guide update project that essentially we start at the time we issue the 23 update. We do expect to have a 24 implementation guide update, and Alan might talk a little bit about some of both those projects when we get to the practice issues section. But then if you continue on to slide 14 in your materials, you'll see an overview of our conceptual projects and our comprehensive projects. The slide looks very similar to what it has the last couple of quarters, but there has been, I'd say, a pretty big development in these projects that I wanted to talk about. It's really discussed on the next 2 slides, kind of in words, but I will just stay here and go over recent decisions that the board has made related to really 2 of these projects. The financial reporting model project is a conceptual project for us. We've been talking about it for really probably 10 years in these meetings. And it is a project that started as a re-examination of GASB 34. GASB 34, which was issued or effective back in around 1999, over 20 years ago, was the biggest change in governmental accounting that probably ever has been or has since been, really significantly altered the financial reporting model. We, about a little over 10 years ago, began re-looking at that standard to make sure it was working the way we intended it to be, because it was such a big change. And by and large, we found that the reporting model was working. as we had hoped, but there were areas for targeted improvements. And really the biggest potential change for those improvements was the accounting for the governmental funds, which actually made some sense because GASB 34, as much as it changed a lot of what we did, didn't change anything in the reporting of the governmental funds and the measurement focus, basis of accounting, and how they're reported. And so we started looking at that. And one of the main things we hoped to achieve, the main objectives of that part of the project, which was the biggest part of the reporting model project, was to create a conceptual, consistent underpinning through which all transactions that run through the governmental funds should be accounted for, because what we had and have currently and have up to now is really kind of a collection of rules about how transactions should be recognized that sometimes may not really necessarily make sense together, but we've been using them for a long time. So those of us that have been around for a while certainly kind of understand and appreciate them, and we understand the information that results from them. But as new people come into governmental accounting, and we certainly want to encourage and remove barriers to people coming into governmental accounting, if we could create a more simplified, conceptually consistent way to run all transactions of the governmental funds through and result in information that was better than what we have out of the current model, that was something we were trying to achieve. That was the main objective. And so we've worked on that. We've been through three due process documents related to that, had a lot of input, a lot of team time, a lot of stakeholder input into those changes. And we got to the end. We kind of went through all that. We got the model as good as we could. And the board stepped back and said, how did we do? What did we achieve what we wanted to achieve? And we were kind of at a crossroads where I saw, and I think the board saw, two paths. One path was we could have a conceptually consistent, simplified way to account for transactions in the governmental funds, but it was something pretty close to cash basis. And none of the board members really liked the information that results from a cash basis of accounting. Fund balance wouldn't mean nearly what it would, right? What it does right now. Things that we think and are currently accrued in governmental funds would no longer be accrued as liabilities. We felt that the information would be worse than what the current model produces, and our stakeholders shared that view by and large. Many of them, whether they're preparers or users, didn't like something that's really close to cash basis for various reasons. And so we didn't like that path. So we were kind of at this point where we had developed a model that wasn't, really close to cash basis. But for that model, it started as a conceptually consistent kind of pure model. But as we were trying to get the information that results from that model to be really somewhat close to what the current model produces, we kept having to create exceptions to the model. We kept having to add complexities to the model. And when we stepped back and looked at it, we said, are we really exchanging one set of rules for another set of rules? And we really haven't achieved what we hoped to achieve, which was the simplified, conceptually consistent model, because we've got a couple of exceptions. We've got added complexities. And so the board looked at it and said, we just don't think that makes sense to ask all of our stakeholders to go through this big change if we aren't really achieving what we hoped to achieve. And so the board voted, a majority of the board decided to take the governmental funds out of the financial reporting model project and move forward with the remaining targeted improvements. And so the other targeted improvements, like improvements to the MD&A, some improvements to a proprietary fund operating statement and its presentation, how the budget actual statements are presented, or where really they are presented in the financial report. Those are all things that will move forward. They are improvements, they're targeted improvements. They're probably not as nearly as significant a change as what we were proposing in the governmental funds, but that will move forward. We hope to issue that as a standard probably in March of 2024, which would keep it on target with what we'd always hoped. The governmental funds part of the project, the board has asked our team to go back, look back at the research on the current model, and we kind of heard that there were some improvements that could be made to the current model that might achieve some of what we hope to achieve, improve the consistency of the information and comparability of that information that comes out of that model, but they would be more minor tweaks to the current model, not a whole relook at the model as we were trying to do. And so the team is putting those together, that list of things where we could tweak the current model through a project. And if there's some inconsistency or something in the governmental funds that we don't think we can achieve through a minor tweak, but would kind of put us on this path of going back in circles of this conceptually pure model that we've spent the last 10 years working on, that's just a problem we're not going to be able to solve. But let's get the things we can solve through achievable standard setting, put those on a list, bring that to the board, and see if the board approves that as a new project, probably sometime later this year, that we'll bring that to the board. And then that would be its own standalone, much smaller in scope project of tweaking the current model. And so that's where we are with that. And as that relates to things that are on the slide, the conceptual framework on recognition was, a separate project from the reporting model project, but was related to it. And most of the changes that we were proposing to our conceptual framework were to result in this new financial reporting model for governmental funds. And since we took that out and we're not revamping the financial reporting model for governmental funds, that project that we just voted 2 weeks ago at our board meeting to take that project out altogether. So in next quarter slide, that project will be removed, even though we didn't issue anything, because there's just no need to make a change if we're not changing the underlying financial reporting model. So that was a big change by the board. Wanted to give you guys pause here and give you guys, if you have questions about that board decision, we'll be happy to answer them at this point. Mary.
So Joel, on the slide, you said that the board no longer believes the costs are justified compared to the benefit. Could you talk a little about the costs and benefits that you see and traded off and how you thought about that?
Yes, this was going to be a big change. And in essence, we came up with this conceptually pure, but with exceptions process that we felt would be good information. It would be really similar information that the current model produces from those governmental funds. But so the benefit, we weren't achieving that conceptual consistency. It was still a complicated model. It was still a set of rules. The information that results would be similar to the current model. So the benefits were kind of marginal, I guess, maybe slight improvements to the information, some starting point of a conceptually pure model that might make sense together. But again, the exceptions were causing complexity. So the benefits were marginal, but the costs were a lot. Every governmental fund transaction for every government, they were going to have to rethink how they account for it through this current model. Now, it may not end up changing how they account for that transaction, but they had to rethink about it. Is it classified as short-term, long-term? We kind of had all these kind of complicated ways to look at transactions. And so it was going to be a huge cost, especially in the year of implementation, for governments to go through that process. And that's where the kind of marginal benefits certainly didn't exceed the significant costs we knew governments were going to have to go through.
So could I just follow up? Did you identify these costs and benefits through your own process, or is this part of a comment letter process or input from your stakeholders about these costs and benefits?
It was both. Yeah, we've spent a lot of time on this project. Certainly we heard from stakeholders all along the way that they would prefer some of them tweaks to the current model. They felt that what we were creating was excessive in its cost and had marginal benefits. And we just kept working on it to try to improve the benefit side. We tried to simplify the model, make it simple, make it easy, make it achieve those objectives we were trying to achieve. And we just got to a point where we kind of had those two paths that we saw and didn't achieve those objectives. So we pushed it off.
Thank you.
Thanks, Mary. Rick.
Thanks, David. I'd like to thank the board for doing this deletion and then actually taking it off the table. Just because that took a lot to go through the process, and it also takes a lot to take it off the table when you spend a lot of time and effort. And I think that goes to show the legitimacy of the conversation. personally, I'm happy. You know, 'cause for someone who's been working with the project as long as I have, it was hard for me to think of it in a different way too. So I'd be one of those stakeholders that would rather see the tweaks. So I'm personally happy with it. But really, I think it just goes to show the integrity that the board went through and really assessing something that would be very dramatic and weighing the pros and cons. So well done, I think, and good, good deliberation on your guys' part.
Thanks, Rick. That is a common theme we have heard in stakeholder responses since the board decision.
Joel, this is David. I just want to add my commendation to you and to the board. It shows the rigor with which y'all have gone through the process here and dedication you've had to the cost benefit analysis. And it's been a good example of that process successfully being employed. So I think it's great.
Thanks, David. All right, I will continue on with the presentation and talk about our remaining comprehensive project, which is the revenue and expense recognition project, which is another one that will have some significant cost to it ultimately, but it is not near as far along. But our kind of second quarter achievements, I guess, progress we made on that project are on slide page number 17. We have spent some time with some pretty foundational elements and come to some, I think, pretty good decisions on things like defining what a transaction is, defining what a categorization unit of account is as a notion, defining what a recognition unit of account is and what a measurement unit of account is, and really trying to create rigor through which we can work this project and work all revenue and expense transactions through these different types of unit account and making decisions that we hope are easily understood and simplified for people as they ultimately get to a point where we implement this project, implement the standard. And we've also made some decisions about what a categorization unit of account should be within this project, which would be the transaction, which is why we spent a lot of time defining that. And then looking at recognition unit of accounts for a couple of the subcategories of transaction in this account or in this project, but we continue to then work on some of the other units of accounts and move forward. But I think we're making good progress. It's going to be a big project. We're still, I say probably outside what we would hope would be a time frame for this project, but we hope to have it issued by 2027, mid 2027 at this point. Maybe we can still speed that up, but we're being very diligent and rigorous in our process to try to achieve the objectives of that project. So with that, that's our comprehensive projects. I'll turn it over to Alan to talk about our major projects and practice issue projects.
Well, I feel like whatever I say about the major ones and the practice ones aren't going to feel quite as important as what you just went through with FRM. So I'll try to do that. I'll do it in somewhat of a higher level because I don't think we need to go into these as much detail. The two major projects, as you'll see on slide 18, have to do with going concern and severe financial stress and infrastructure. Going concern and severe financial stress, just to remind y'all, is our literature for a long time has been based on the same going concern notion that FASB has and the same idea of what going concern is. But if you think about that in the government space, when do governments really cease to exist as a going concern? Detroit's been in a very bad place for a very long time and it still exists. And so what this project is really trying to do is separate going concern, the idea they'll cease to exist, from severe financial stress. In other words, they're in a bad financial condition, bad financial shape, and they might be there for a while, but there's no required disclosure for that at the moment. So what do you do with Detroit? What do you do with Puerto Rico? Should they have to tell you that they're in severe financial stress? Well, they might still be a going concern. That's what that product's trying to do. We're making good progress on it. We've defined going concern, or a new version of it. We defined severe financial stress. Now we're going to talk about factors that would lead to those, factors that would lead to be severe financial stress. And then we'll go through some user outreach on whether or not the disclosures may or may not be what they're looking for, with a PV about this time next year. Infrastructure is a product that came out of our capital asset research. We did research for many years on capital assets. Wouldn't surprise people to know that when you look at capital assets on a broad brush, people understand what historical cost is. People understand what useful lives are. Don't always get them right, but they know what they are. They know what depreciation methods are. They know how to do the math. They know how to impair an asset. A lot of those things they know and they get right, and that's what the research showed. There aren't a lot of worries in terms of someone understanding what's the historical cost of an asset when you acquired it and placed it in an operation. But, the government space has this one unique idea is we have these long-lived permanent assets that stay in place for long periods of time, these infrastructure assets, roads, bridges, sewer lines, water treatment plants, these things that these governments have for very long periods of time. And that's a whole different animal when it comes to, do we get all those right? Do we get the useful life on that right? Do we get the method of that right? And quite honestly, you can't really have a conversation with that without having this conversation about, but you're deferring a lot of maintenance costs associated with those assets for down the road, and you're not paying for them right now because you'll pay for them down the road. And so what this infrastructure project is about that. We changed it from capital assets to infrastructure. Let's deal with these long-lived assets that have a public service that are very different than a book or a car or the things that we know we have capital assets for. And let's look at that. It does have recognition and measurement in it. In other words, we're going to look at it. What is the right way to recognize it? What's the right way to measure it? We've kind of taken off the table so far. The board's taken off the table this idea of using something like fair value replacement cost. It's not really about an exit price. It's really about that entry price for historical cost. This preservation method is still something on the table to talk about that more and talk about a preservation method. But this might be a project where we get to the point of saying, there's not really anything we need to do different recognition and measurement. The recognition and measurement piece is not really our problem. Our problem is we don't provide really a whole lot of disclosure at all around these infrastructure assets. They are different than just, or a subset, or they have a different characteristic, if you will, than just capital assets as a whole. And should we be given more information about them and letting people have an idea of, hey, how much money do you spend on these things? While we might not be able to tell you what your deferred maintenance is, we might be able to tell you how much money you spend every year on these type of assets to give people an idea that you have these assets on your books. As you can probably imagine, what's the net book value of the cobblestone roads in North Boston? Probably zero. Is money being spent to maintain those roads every year? Yes. Is there a requirement to really separately disclose it right now? No. So that's really where infrastructure is going. We just started last quarter. This project will take a while. It'll probably take from now until Joel's term is over, but we're going to diligently work through that, and you'll see probably a PV and an ED down the road. But that's where we are with infrastructure. And we hadn't really talked about that since the last meeting, so I wanted to go into that a little bit of detail. The three practice issue projects that are on slide 19 are much higher level. The disclosure of non-financial assets is really about making sure our stakeholders and our users and preparers. Diane, you had a question?
Yeah, yes, back on the infrastructure.
Yeah.
You can take it if you'd like. Have you thought about introducing climate change impact, or are you going to leave that kind of for others to figure out?
No, fair question, but as of right now, no. As of right now, really, Diane, what we're trying to get into is what makes these infrastructure assets different than just capital assets, and are the users getting the information they need to assess whether or not really, I think the question that some of the board members are grappling with is, do the users get the information they need to know right now to know whether or not those infrastructure assets are being maintained? Or is there some, I don't want to use the word deferred maintenance because that's a word that gets thrown out a lot, more preservation methods, another word we talk about a lot. Another way of thinking about it is, do they have information to know whether these things are being maintained or not? Or is there some big, for lack of a better word, big cost down the road a little while that the taxpayers are going to have to incur that's been deferred for the future years? So no, we haven't gotten to climate yet. No, good question though.
Okay, thank you.
Yes, ma'am.
Alan,
Yes, sir.
Just highlight for Diane, we did in our research find that impairment standard GASB 42 is working pretty well. We found people understand it. And so if a government's infrastructure or any of their capital assets are impaired under that standard by a climate event, then we already have accounting that addresses it. So, to the extent you might be looking more in the future, that's not something we're necessarily addressing, but we do have current standards that would address some of climate issues, I guess is how I would characterize it. But we found that part to be working pretty well for all capital assets.
So the three practice issue products, the one on classification of non-financial assets really was us looking into, we have these, we're going to talk about one on this afternoon, these right to use standards on leases, on subscription-based IT arrangements, on P3 arrangements, and really making sure that the users and preparers understand how to classify these type of arrangements separate from owned stuff. In other words, do you want a leased building disclosed the same way you want an owned building? Do you want internally generated software you're using disclosed in the same way you want subscription-based software as a service arrangement? And it started out as whether this wasn't about recognition and measurement, never was. It was about disclosure. It was really about making sure we get the right level of aggregation or disaggregation for the disclosure. As of right now, this is all notes. This is all notes of the financials. There's no real requirement to change really the face of the statements. This is about making sure you disaggregate on the notes in really the capital asset roll forward, which is where it really shows up. Those things like owned buildings versus leased buildings, internally generated software versus right to use. So separate the right to use stuff so people can see it. The other thing the board's done is define better, which we had never really defined or never clearly defined, this idea of held for sale. Governments do tend to periodically sell assets, and should you separate those held for sale assets from your owned assets? We again did not requiring the governments to remeasure it, but to be able to separate, and there's criteria for that, to be able to pull those assets you're holding for sale away from the rest, because the users did say they'd want to know, primarily for liquidity purposes and such, they want to know whether or not a government had an asset they were planning on selling, separated from the assets that they're still holding and using in operations. So we're allowing that to be separated. But again, there's no recognition or measurement changes in that project. The implementation guide, Joel's right, we did that. We did that earlier this spring. June 5th, I think, is when we finally issued it in the quarter. It's got 10 questions. Interesting enough, you think 10 questions isn't a lot, 3 of which are around SPIDA, they're around Statement 96. We will talk about those 3 questions later on the day. What you'll find is those 3 questions were highly helpful to our user base to help them with some clarity on how they should actually address some of the Statement 96 issues we've had. And so that's been quite useful, and I think been quite well received. The last product on those lists is certain risk disclosures. GASB's not, and we haven't had historically anything similar to 275 that we have in the FASB land. There's been risk disclosure criteria under topic 275 for quite a long time in FASB, and we've not had one. We now have a standard in which we hope to go final with by December, which somewhat, it's really based on concentrations and constraints. Concentration being something where you have a concentrated industry or concentrated employer. Think of a small city or county that has one major employer, and what the risk would be if that one major employer left that jurisdiction. Or a constraint, which is also probably unique to us in the sense that you have a cap on your ability to raise income tax rate, or you have a cap on your property tax rate, or you have some other kind of constraint that limits your ability, or limits your financial flexibility and your ability to actually respond to or deal with an issue the government might be facing. And so we've limited it to those kind of things, but we do talk about vulnerabilities to the risk and whether or not this makes a government vulnerable to the risk and the level of the risk and the type of risk we're talking about. So there's some parallels there. And the disclosures are about the event. The other thing we've added too is this idea of there's actually a risk, but there's also an event that could actually, that's related, that could cause that risk to actually eventuate. In other words, there's an event that could actually make that risk real. The board thought let's just not list the fact that you've got a major employer. You've always got that major employer. Let's disclose it when you actually have something that, let's say that employer has told you they're leaving, or the base closure is going to happen. So there's something that's happened. There's an event that's happened that's told you now that that risk is now going to become, for lack of a better word, real, or there's a probability of it becoming real. And so that product is getting its end stage. That went through a lot of redeliberation. There was a lot of comments, both from the preparer auditor and the user space. And we should be hope we'll be at a pre-ballot in November and about for final in December. So we should have that project finished. The last slide, I don't know why capital assets is on here as pre-agenda research. That's my fault for not updating it on page 20, slide 20, because we just talked about infrastructure. And subsequent events is a project we just got through research on, which we will talk about at the end of this month about whether that's a project. You might be surprised, and if you went the research paper, you might really be surprised, I was, that governments don't get subsequent events right as often as we think they would. And things as simple as you issue bonds in July after your end, you would think would be a no-brainer subsequent event, and yet the research would show they miss it often. And so there might be some work we need to do with that. And so I was a little surprised they missed it as often as they do, but I think that might be something the board will talk about at the end of this month. Whether or not we need to research our product on that. And really about is how we defined it right. Do we need to better define it? We need to better have information to help people identify them more consistently, because there's obviously some questions on that. And then the last slide, which is on slide 22, is just where we are at PIRs. We had slides in the past that were bullets, and there were a slide for the PIR project. I've condensed it into one page. I think this visual for me helps me, and hopefully it helps y'all. It helps you get a real quick idea of where we are, whether it be completed, and the dates in the completed column would be what they mean. We're through that stage, and this is when we completed that stage. And then the right of that to be completed is where we are. And And the green just being we're tracking to where we thought we should be and where the tech plan thought we should be. So that just gives you an idea if we think we're on schedule or not. And then to the right, the comments are about just what we're doing right now and what projects we're working on right now, or what steps we're working on within the PR project. So I thought a one-pager that was a little more visual might be a little more, it's helpful to me. So I thought it might actually be good for y'all too. I'll stop and allow folks to ask questions.
Any questions for Alan? All right. Thank you for that good presentation, Alan. Okay, that concludes the GASB report by Chairman Black and Alan Skelton, and we'll move to the next agenda item we have, which is item number 3, the second quarter 2023 FASB report, the Financial Accounting Standards Board, by Chairman Jones of the board and Hillary Salo, the technical director.
Great. Good morning and thank you. We'd like to spend the next about half an hour walking you through some developments for the quarter and providing some insight into maybe what's next here at the FASB. We're going to focus on our technical agenda, some of the due process milestones we achieved during the quarter, and some of the significant standard setting activities we've had on specific projects, but also want to spend some time on our post-implementation review activities and giving you an update on that project. If you move to slide 25, you'll see this is our roll forward of our agenda. You'll see that we added one project during the quarter and we issued 2 EDs during the quarter, and Hillary's going to cover them a little more in depth. And a little later, I just want to speak a bit with the committee and give you some insight into, as you see, our agenda is rapidly being completed. And what does that mean? Does that mean we're running out of standard setting activities, or does that mean no, there's other things coming around? So to give you some insight into that. But with that, let me turn it over to Hillary, who's going to start off with the tech.
Maybe if we move to slide 26, and we just want to spend a couple of minutes to summarize our work on projects where we've had our due process milestones over the last quarter. So if we actually move to slide 27, we wanted to start with our profits interest project. So we issued an exposure draft in May that's intended to improve GAAP by really adding illustrative guidance to help entities determine how to account for profits interests in similar awards. So profits interests are really a form of performance compensation that is more typically issued by private companies to better align compensation with the company's operating performance. However, profits interests are different than other capital interests because profits interest holders only participate in those future profits or equity appreciation, and they don't have rights to the existing net assets of the partnership. Now, our private company council identified that there's existing diversity in practice in how companies account for these awards, either as a share-based payment arrangement or similar to a cash bonus or profit sharing arrangement. And so the PCC set up a working group that completed outreach and research on this topic and was really instrumental in identifying potential solutions. However, as certain public business entities, as well as private companies, issue profits interest awards, the PCC ultimately recommended that the board take on this project to provide illustrative guidance for all reporting entities for their ability to account for profits interest in similar awards to help reduce that diversity in practice. Since the project team began work on this project, we've had 73 discussions with stakeholders on this topic, in addition to having discussions at 9 advisory group meetings, including the PCC and FASB. And so these advisory group meetings really allow us the ability to talk with a broad range of stakeholders that would potentially be impacted by the guidance. But as you can see from this slide, we did receive the most feedback on this topic from a practitioner perspective. We issued our exposure draft in May and comments were due in July. We did receive 20 comment letters on the exposure draft, and we're in the process currently of analyzing those comments and expect to bring that back to the board here in the 4th quarter from a redeliberations perspective. All right, then maybe I'll move on to slide 28.
Hillary, maybe before we end that, just some context. You will see that the input we got on this project is skewed toward practitioners. And part of the reason for that is it was challenges in applying the guidance versus us changing what the intended outcome from the original standard was. And that's typically practitioner, particularly in the private company space. Very often those practitioners are the first line of defense, or the first attempting to look at it and understand what the guidance is. And so in a way, you'll see the input we got is slightly skewed, but that's because of the nature of the project and because we weren't necessarily changing the outcomes. Hillary, I think we have two questions. I saw Mary first and then Diane.
I was just going to a quick follow up, Rich, on your last comment, or Hillary, you can take this if you like. If it's all about how they should be implementing the guidance that's there, does that mean this is going to be a quick project? In other words, when the board looks at it and said, this is what we intended, and therefore here's the answer to your question? Or is this going to be kind of a rethink of how this should be done?
Mary, I would say this isn't a rethink. This is really providing illustrative guidance. We have existing gap for whether people are accounting for these as share-based arrangements or as profit sharing arrangements. So it's really just helping people identify under their specific facts and circumstances, should they be looking to the guidance in the share-based payment arrangements or into the profit sharing guidance. So it should not be a relook with regards to the accounting for compensation arrangements.
And then my question is kind of adding on to Rich's context, which I found very helpful actually as a relatively new member of this committee. The oversight, part of the oversight we're trying to do is not just outreach, but effective outreach. And so anytime you can say, say this is more or less than the past, or this has been deemed more effective or less effective than the past, we did email or we did face-to-face or advisory groups versus individuals. That would just help me going forward. I know you have a lot of pie charts about, how many people did what, et cetera, but I'm kind of lacking the context. So I appreciate your comments, Rich, and anytime you can key in on how effective the outreach was, that would be ideal. Thank you.
Great. Thanks, Diane. Great comment. Sorry, Hillary, back to you.
Absolutely. So we'll move to discussing our next project, which is the accounting for purchased financial assets. So this project really came out of our post-implementation review process related to our credit loss standard. So we heard feedback, particularly from investors, that the board should reconsider the accounting for financial assets that are acquired in a business combination or in an asset acquisition. And really just to put this project in context, let's say that you buy a pool of loans with a par value of $100 and you pay fair value. Let's say that's $90. The fair value that you paid in part is going to reflect a discount from the par value of the loans based on your expectation of that future credit risk that's inherent in those loans. Under current GAAP, there are actually two accounting models for purchased financial assets. And depending on what model you're under, you may be required to record a credit loss on the day that you purchase the loans, even though that credit discount is already reflected in the fair value of the loans that you purchase. So we received feedback through our post-implementation review outreach that this quote unquote double counting of credit losses really creates unnecessary complexity, it reduces comparability, and it is not intuitive from an investor perspective. So this was something that was a significant topic that was discussed during our CECL public roundtable discussion. And given this feedback, we really then conducted a significant amount of one-on-one outreach, having discussions with investors as well as preparers on this topic. And we've talked with over 70, had 70 different discussions and spoken with over 128 different stakeholders related to this topic. And what we heard consistently, especially from investors and preparers, is that they really would prefer to have a single accounting model to recognize credit losses for all purchased financial assets, and that they were really concerned with expanding the use of the accounting model that would require this double counting of credit losses. So after extensive deliberations, the board did decide that all purchased financial assets should be accounted for consistently following the accounting model that doesn't result in the double counting of credit losses. So we did issue our exposure draft at the end of June related to this project, and comments are due at the end of this month. So this is one that we're certainly looking to, get feedback on from preparers and investors. And we've heard a lot of feedback already, but are looking forward to hearing more feedback on the specifics of the exposure draft.
And this is I would say one of the top three issues we heard in the post-implementation review, and I think it's a good example of how an effective post-implementation review has benefits from the moment the standard is issued, because it raises issues, and it raises issues in accounting that can be improved. And I think it's important that we as a board actually act on those timely. Regarding this proposal, you may have seen we've gotten a few requests to extend our comment period. And the board selected a 60-day comment period ended August 28th. And to change that obviously would require board action. That being said, some have called up and said, hey, listen, I'm going to be a week or two late because my CFO is on vacation the last 2 weeks in August. What happens? And, you know, we've told them, hey, listen, this is the comment letter deadline, but it would certainly be somewhat tone deaf to say that if your comment letter comes in a week or two late, we're not going to look at it. So of course we are. So we've had some of those conversations with some of our stakeholders to make sure, but I do want to emphasize, we set the comment letter period as a board decision. We set it really because it's important that we get the information as timely as possible. That being said, if something comes in a little late, we certainly look at it. We don't close our eyes and ears and say, nope, too late. We don't consider that. So I think that's an important part of our messaging and dialogue with folks.
Last with regards to this section, if we go to slide 29, we also just wanted to highlight that we added a new project to the technical agenda during the second quarter. This project really originated from an agenda request that was submitted by the Big Four accounting firms, and it impacts both public and private companies that obtain financing through the issuance of convertible debt. Now, this is a pretty narrow technical accounting issue, but really this project is focused on whether entities that settle convertible debt instruments that are using terms that are different than your stated contractual conversion provisions, whether that should be accounted for as an induced conversion or an extinguishment. Now, that's really important because the magnitude of either the expense or the loss that's recorded upon the settlement of that convertible debt instrument will be significantly impacted if the settlement of the convertible debt is accounted for as an extinguishment versus as an induced conversion. So that can have a pretty significant financial reporting effect. And really what we're looking for is to provide some additional guidance there with regards to some of the changes that have been occurred with regards to the types of convertible debt instruments that are being issued in the marketplace. The board unanimously decided to add this project to the technical agenda in April and then assigned it to the Emerging Issues Task Force to work on this issue. So we did hold an education session with the EITF in June, and we are bringing this project back to the EITF in a few that would then come back to the board for ratification before issuing an exposure draft. And with that, Rich, maybe I know if you wanted to touch on maybe a couple of other items on our agenda.
Sure, and I think we faded out. So Hillary did mention that it's going to the EITF in September, and then to the extent the EITF concludes back to the board. So just in case that broke up. If you move on to slide 30, other major developments. This is kind of a preview of some of the other due process milestones that we'll be talking about in future meetings. We did issue an exposure draft on disaggregation income statement expenses, or as our team likes to call it, DICE project, which I would emphasize was probably the single most frequently cited project in our investor outreach. So we're excited to get that exposure draft out there. Our comment period goes through October 30th, and we're really looking forward to what we hear from stakeholders. And we also have a roundtable plan toward the end of the year to bring all different stakeholders together as they look at this issue. There's a lot of feelings about the importance of the information, but also on, maybe some ideas on the best way to get there. So to bring those different stakeholders together, and we'll be doing that before the end of the year. And we've also directed the staff to draft final ASUs on 3 projects that are listed here, including segment reporting, one which I think our board is very excited to be done with. It is something that will impact just about every company out there. And it responds to the most frequently cited investor concerns specifically. And it's very targeted. And we're looking forward to that standard being out there and looking forward to the information it'll provide to investors. Hillary, maybe I'll flip to the next slide with you.
If we move to slide 31, just an update on timing on a few of our other projects. We are planning to complete redeliberations for 2 projects that were identified as high priority areas through our agenda consultation process, which includes our accounting for crypto assets, as well as our improvements to income tax accounting. So we did issue those exposure drafts in March, and we've been able to work our way through those comment letters and through other feedback that's been done from or outreach by the staff during the comment letter period. And we're planning to come back in the next few weeks to discuss those from a redeliberation perspective. Assuming that the board is able to make decisions on those projects, we would be looking to issue final standards by the end of the year with regards to those projects. We've also made some great progress with regards to our accounting for and disclosure of software cost project. We've really been able to kind of get down to a single model with a capitalization threshold that's based on when it's probable that a software project will be completed and that software will be used to perform the function intended. The staff have developed the further details associated with that single model, and we're going to be bringing that back to the board here in later this quarter. And last, but certainly not least, I do want to highlight that we're making really great progress on our project on interim reporting. Now, this is not a project to kind of holistically reevaluate interim reporting requirements or make any major changes to the level of interim disclosure. But it is really important because we're looking to do a couple of things here. One, we're looking to add a disclosure principle to our interim reporting guidance. That disclosure should be provided in an interim period when significant events have occurred since the most recent annual financial statements. And this is really bringing into GAAP guidance that used to be in the SEC literature. And we think that's a really important principle to be included in GAAP. And then also we're looking to clarify which disclosure requirements in the codification are actually interim requirements. This may seem like something that's rather self-evident, but over the years, it turns out we haven't been very consistent with regards to our wording of whether or not certain disclosures are required on both an annual and an interim basis, or only required on an annual basis. So we are reviewing the over 900 individual disclosures throughout all of our different topics to make sure that we have a complete and clear population of disclosures that are required on an interim basis. And we really think that that's going to be helpful from a stakeholder perspective to know that they have that complete and accurate list when looking at their reporting requirements. So maybe Rich, I'll turn it.
Thanks, Hillary. Slide 32, it is a copy of our website project plan. And just as a reminder, this is where we list all of our authoritative standard setting activities, what the next milestone would be, and then effectively Hillary and my's projected timing for that next milestone should our board decide to move forward to that next milestone. And I'd emphasize that point. And this is something that we thought was extremely important for our stakeholders to give them an idea of what was coming and the estimated timing of it. When you look at it, you'll notice that over half the projects are expected to be done in the next several months. And so the question is, well, what does that mean? What's next? And I'd emphasize that we have a robust research agenda where our staff is diligently doing work and we'll be bringing potential projects along with potential solutions for our board to consider in future meetings. We still have a steady supply of stakeholders providing us with agenda requests. But I think what this does lay out, it shows the agenda outreach we did, the way we populated our agenda, and our ability to move through that agenda based on that important stakeholder input. It does lay the groundwork that it's going to come time for another agenda outreach, which I do believe will probably occur next year. And I think that's important because, we've just done a lot. We've done and we're doing a lot of standard setting. I think it's important that we do that proactive outreach with our stakeholders to make sure we're headed in the direction that's most appropriate for those stakeholders. Hillary, back to you.
We've spent a lot of time on our technical agenda, but if we move to the next slide, slide 33, I just want to quickly cover changes to our other projects, which include our framework projects, our research, and our post-implementation review projects. So we did complete redeliberations on our concept statement chapter related to recognition and derecognition in the quarter, and we do expect to issue a final concept statement chapter in the third quarter on recognition and derecognition. And we also discussed our measurement project with the board, and we are expecting to expose a concept statement chapter later this year on our measurement chapter. If you move to the next slide, so slide 34, we also issued our final concept statement chapter on the reporting entity. So the term reporting entity is used in the concept statements, but there was not really a developed concept or description of a reporting entity. So that's really what this chapter is intended to do. And we added this project in June of 2022, had many discussions on this topic with individuals from a practitioner perspective, from an academic perspective, as well as with certain advisory groups, and did receive about 13 comment letters with regards to the proposed concept statement chapter. And based on the responses that were received, we did receive support for the finalization of this chapter with certain clarifications. And the board did agree and decided to finalize this concept statement chapter in the second quarter. But I think when we think about the concept statements in general, Rich, I know you wanted to kind of take them through the overall.
I think we lost Hillary there for a minute, even though right next to me. Sorry, Hillary. Yeah, the concept statements, we do expect to complete our project on the concept statements sometime next year. And I think that's an important milestone. This is an important tool for the board. The concept statements are things for the board members to consider as we're setting new standards or as we're revisiting old standards. It's not the Constitution, right? We don't need a 2/3 majority to override it. But I think it does bring an important focus on the board on, as we're looking at a standard, are we being conceptually consistent or not? And where we're not, is there a good reason for that? And so we're excited to finally have this done, or almost done. I'll be excited next year when it's done. And that we have a comprehensive set of concepts for our board and future boards to look at. So that'll be an important milestone. Hillary, maybe we can just jump to PIR activities, and then I want to make sure we have some time to answer a few questions from our trustees.
So just a couple of highlights from a PIR perspective. From a credit loss perspective, we've issued our exposure draft on purchased financial assets, which came out of a lot of the discussions we've had through a PIR perspective, and we are expecting to begin those redeliberations in the fourth quarter. From a leasing perspective, we do continue to assist stakeholders responding to inquiries. And we certainly had an uptick in inquiries over the last quarter with regards to the common control leasing guidance that we issued in the first quarter of this year. So helping stakeholders understand how to apply that guidance. And we've also had some really great discussions with the IASB as well as with the Accounting Standards Board of Japan with regards to leasing topics that are coming up from an international perspective as well. And lastly, from a revenue recognition perspective, we're continuing to work through our process. We've actually completed our relevant academic research, and we are finalizing plans for a public roundtable discussion that we're planning to hold in November of this year to be able to get feedback from a broad range of stakeholders on our revenue recognition guidance. With that, Rich, I'll turn it to you.
Okay, I believe that covers what we prepared to talk about today. I did want to see if there were any questions remaining from the trustees.
Any questions of Chairman Jones? Okay.
Great. Well, thank you. I appreciate the oversight, the interaction with our trustees. I think what we've laid out for you today is really the results of I do believe we have the right agenda. We are executing on that agenda, and we are moving through our projects fairly quickly. I do see Ed's hand came up.
Yeah, thanks, Rich. I think I dare say I speak on behalf of the Oversight Committee and the trustees as a whole that we're all very supportive of it. You mentioned the amount of standard setting work that's coming through the pipe, if you will, getting to the finish line. And we know it's very responsive to the outreach you've done before, and you talked about doing some more next year. But as these are actually becoming standards, can you talk a little bit about or explain how the board thinks about and ensures cost-benefit analysis?
Sure, Ed. No, it's a great question, and there's no doubt there's a lot going on in the world today, right? And if you think and that's from all of our stakeholders' perspectives. It's from the investors and the information they're processing, the preparers and the different competing demands they have, not just from accounting, but from other regulatory matters and other business matters and the auditors as well. And we don't set our standards in a vacuum. I think some of the things that our board is doing, though, are as part of that cost benefit analysis. And I thought Joel gave a great example of this earlier in the GASB update, is, you know, revamping a standard and forcing people to go through a full reanalysis of an accounting area where there's not much change in outcome. I don't think that really helps anyone. And it's not helping the investor because they didn't get much of a change. And it does drive cost and complexity into the system. I think we're very focused on that. I think when you look at our agenda, you'll see that we have targeted our standard setting to the information that the investors have told us is most important to their analysis. I think segment accounting was a good example of that. We heard consistently from investors that it was the expense information for existing segments that they were looking for. I know some might have liked us to have redone segment reporting as a whole, but to do that would have delayed the information to investors, and it would have imposed additional cost on preparers. And so I believe our board took a direction that provided that most critical information to investors, and we can do it in a more timely fashion because that's information that preparers have today. And so we factored all of that in. I think the other part is anytime we set a standard, we get input from all of our stakeholders on timeliness. What's the timing? Because it's in all of our best interests that standards are adopted in an effective manner and the best information comes out of them. And if there are other competing demands on preparers, if there's a huge regulatory initiative in a given year, we consider that, and I hope others do, right? Consider all of that and what burden's being put on there, because at the end of the day, we want the best quality implementation possible. So we do factor it all in, Ed, and the way we get the best information to make that analysis is from our stakeholders. That's why every time we meet with our stakeholders on a standard and every exposure draft we issue, we ask people, what's the timing that makes sense? What's the effective date that makes sense? What's the transition that makes sense? And that helps us come up with what I think is the best cost benefit conclusions for our standards.
That's very helpful. Thanks.
Okay, anything further? Any other questions of Chairman Jones or Director Salo? All right, seeing none, thank you so much for that great report there from the FASB, Rich. And the next item we have on the agenda is item number 4, which is the FASB Liaison to the Private Company Council, the PCC. Sue Cosper, as a member of the FASB, is our liaison. Sue.
Thanks, David, and good morning. Our last PCC public meeting was held in person in our offices on June 22nd and 23rd. Our new user member, David Hoagland from US Bank, joined us for his first meeting, and we provided him orientation on June the 9th. The PCC report is in your materials beginning on page 39. In terms of meeting dynamics, there continues to be very good engagement and dialogue among PCC members and between the PCC and the board. At the June meeting, the FASB received feedback from the PCC on a variety of active projects, including the accounting for and disclosure of software costs, including the continuing research of the staff and refinement of a potential single software development cost model. Also, on our profits interest awards plans projects, the staff provided an update on the exposure draft. We're incorporating illustrations into the codification. That comment period closed on July the 10th, and the plan is to discuss the feedback with the PCC at the September meeting. On our improvements to income tax disclosures project, the staff provided an update on the comment letter feedback on the exposure draft related to private companies, and PCC members also provided additional feedback to the FASB on certain aspects of that project, and a very productive discussion ensued among PCC members and the board. The PCC also had a status report on the PCC's working group research project and the disclosure of share-based payment disclosures. And there were a number of regular staff updates provided on a variety of other projects. As it relates to town halls, we discussed the summary of the dialogue at the PCC town hall at the AICPA's Engage conference. Myself, Candy, Robert Messer, Jeremy Dillard, and Jim Crooker attended that town hall, and there was a productive discussion on a variety of topics. In August, we also held a town hall at the AICPA Peer Review Conference in Philadelphia. Myself, Candy Wright, Adam Roark, and Dave Pesch attended, and we will update the PCC on the dialogue at that time from that town hall at the September PCC meeting. Our next town hall is planned with the Risk Management Associates in October. The next PCC meeting will be held in person in Norwalk on September 11th and 12th. And this is the meeting where the PCC has their annual in-person meeting with the Technical Issues Committee of the AICPA. And the FASB as well will have a separate meeting with TIC on September the 12th. With that, I will just pause here for any questions.
Okay, any questions of Sue? Well, thank you for that great report there. We appreciate your efforts on behalf of the PCC and the FASB.
Thank you.
Okay. All right. The next item that we have is item number 5 on our agenda here. Report on the June 22 to 23, 2023 PCC meeting. Observations by Rick Reisig, trustee.
Thanks, David. The only thing I would add, well, and really just to confirm what Sue mentioned, the notable things for me, one is it was in person and I was able to participate as an observer in person. And I think we all understand the dynamics that go into a live meeting. Just, and just think of this meeting, if we were all together, it just brings out so much more when people can see each other and see body language, and the conversation is much more spontaneous. The one comment that I made to Candy Wright, I might even have made it to Sue at the end of the first session, was that the users really came to play. And I asked Candy if she had prompted them ahead of the meeting, and she said she had not. The 2 users plus David, the new user, a participant of the PCC, were all very engaged, and to their credit, even offered commentary that was I wouldn't say in opposition, but a different perspective than others that were being offered, which is exactly what you want. And they weren't shy about joining in on any of the topics, and it was very engaging, and it was very fun to observe. And I'm sure the PCC members and the FASB members got a lot out of the interaction. So just as Sue mentioned, great dialogue all the way around. And again, the users really added a lot to it. I was very pleased to see that. And I know it will continue to be based on the type of folks that they are. So no, good meeting.
Very good. Any questions of Rick about his report on this PCC meeting? All right, very good then. We'll move on to the next item, which is item number 6, report on meeting observations, the oral reports, various meetings. Diane Norden, trustee, had a report, I think, on the FASAC meeting.
Terrific. Thank you. I attended virtually the June 6th FASAC meeting, which was held, as Rick mentioned, his PCC meeting, largely in person. So I didn't get the kind of the touch and feel that Rick just reported, and I'm looking forward to attending one in person when schedules allow. So, but a lot of the information that was shared, I'm sure the agendas are available to all of you, but a lot of the information that was shared and the discussion had followed the items that Rich and Hillary have reviewed in today's meeting. My impressions to share with this group are that it's a large group, it's a diverse group, it's a very engaged group, and again, virtually, I sensed that it was a very well prepared group, just reading the materials in advance, et cetera, et cetera. And given the challenges, I think there were several members that might have been virtual as well, but mostly in person. It was extremely well led. I know those meetings can be hard, especially after, it's a hybrid, a little bit of a hybrid. But everyone seemed to be very well prepared, engaged, and the diversity of the group was made an impression on me as far as different points of view. Given the size of the group and the need and the desire to get input, the breakout sessions on the various hot topic, like accounting for software costs as a topic, for example, I think was a must-have, the breakout sessions. Instead of holding that in a large group. I wasn't able to attend the breakout sessions, but it seemed to be a wise choice, which I'm sure has been standard operating procedure in the past as well. So again, a very positive impression. Engagement for me is, as I mentioned in an earlier question, effective engagement. To have people there is one thing, to have them engage effectively is another. And from what I sensed and what I hope to sense in a future meeting, it was a very well prepared and engaged group. So kudos to the leadership of the committee chairs, et cetera, and management and staff.
Okay, any questions of Diane about her good report there? And thank you for that, Diane. Thank you for attending that meeting virtually and dealing with it. The next item would be, I think Marion G has a report on the GASB meeting from June 27 to 28.
Thank you, Mr. Chairman. I had an opportunity to observe the GASB meeting again that was held on the 27th and 28th of June. I did plan to participate in person, but unfortunately, there was some inclement weather that took place on the East Coast, and along with myself and several of the GASB members, we had to participate virtually. I do hope to make an in-person meeting soon, though. The board had several items on its agenda, including some things that Joel had mentioned earlier, the classification of non-financial assets, the financial reporting model, which I will provide some additional comments on, risk and uncertainty disclosures, going concern, uncertainties in infrastructure assets. In addition, the board held an informational session to provide information on topics associated with electronic financial reporting. I do want to take a moment to just talk about the financial reporting model. As Chairman Black indicated earlier, that was an agenda item that was really closely monitored by stakeholders and users, as it would have had a significant impact on the reporting requirements for governmental entities. As Chairman Black stated, the board tentatively decided to remove issues related to the reporting of governmental funds from the scope of the project and from the guidance of the final statement. The rationale for that decision, again, was that the board didn't believe that the benefits of the proposal to users and other stakeholders would justify the perceived cost to implement the changes, nor would reporting significantly improve by implementing those changes being considered. My observation during the meeting, I heard a lot of comments from the board that centered around user and stakeholder input as some basis in terms of the decisions that were made. I hope that that reinforces those stakeholders and users that take time to provide comments to the board, that their comments are considered. And I think that the actions taken do kind of reinforce that. The meeting was my first opportunity to see how the GASB staff interacted with the board, and I was highly impressed with how well prepared and that they were, and the completeness of the information that they shared with the GASB board. I would also like to commend Chairperson or Chairman Black and the board for the thoughtful approach that they took during the deliberation process. There was a diversity of opinions that were discussed, and I felt that all the board members contributed, and so I was really pleased to see that. This concludes my comments, Mr. Chair.
Okay, are there any questions of Marion or observations about his good report there on that meeting, the GASB meeting? Thank you, Marion, for your good work on that and everything.
Thank you.
The next item we have on the agenda is a report by me on behalf for the reviewing the GASAC meeting for August 7, and the GASB meeting from August 9. Unfortunately, my wife suffered a health mishap right before that, and I was not able to participate in those meetings. I will review them from the tapes and have a report for a future meeting of this committee. So we'll schedule that for the next meeting of the committee. I do want to take just a minute here at this point to point out, in our continuing effort to improve the user experience in these public meetings generally, not just of this committee, but also of all of the boards and committees under the FAF and the GASB and the FASB, we probably need to look at my observation in past meetings about adding subtitles that ID the speaker that's speaking. In the meeting we have here today, it may not be as critical simply because I'm introducing each speaker and everything, and so it's not as critical. But for instance, on the Governmental Accounting Standards Advisory Council, the GASAC, there are approximately 25 members of that. The FASAC that Diane Norton reported on is a relatively large body. And sometimes the colloquy back and forth about the issues being debated gets to the point where if you're not familiar with the person, then you may not know who is actually speaking. And that's particularly true, like in the GASAC meetings. It's a webinar where you're not looking at a video of the individual, you're listening in effect to an audio in some cases. And so all of us, we know all of the people on these boards and advisory councils and everything pretty much, but the public would not. So I think in the future, we will discuss that in the Oversight Committee about talking with the communication staff about that issue. All right, at this point, I think that concludes our public session agenda today. I want to, on behalf of the Financial Accounting Foundation and the Financial Accounting Standards Board and the GASB, the Governmental Accounting Standards Board, thank you to the persons who participated in this meeting today from the public to look at it. And we appreciate it and approve of your participation and hope that you will give us any comments or feedback on our presentations here today or other things that you think need to be improved as part of this. And with that, we thank you and we will adjourn this public session.